The word investing is so closely linked with the 1% that the average man forgets it's an opportunity for them too. While the world of investments might have been confined to a specific socio-economic level in the past, the door is now wide open for all to try their hand in the markets. The invisible wall that has discouraged investment by regular individuals has been knocked down by several companies and budding services that have brought the opportunities that investment allows to the common man. Nowadays, those with even a little knowledge and money can also start investing. There are now so many investments available for the unskilled that it's no longer a valid excuse to skip out on a great way to build your assets. In this video, we are going to be talking about the best places to start investing as a beginner. Before we begin though, make sure to subscribe to Finance Hive and hit the bell icon for notifications. Now, let's get into it. Investing is a great way to make your money work for you. With each passing day, inflation rises. This means that a single dollar could go further in the past than it does today. By investing, however, you are able to compound your money. Compound earnings are earnings that are put back in a business or reinvested to provide even more returns. As a beginner, there are certain things you need to know before dipping your feet into the investment pool. First of all, you have to have a clear aim of what you hope to achieve and how long you plan on working towards said goal. If you want quick returns, then a particular investment might not be the best option for you. Any form of investment carries a certain level of risk due to the volatility of the market. Before stepping into the ring, you have to know your risk tolerance. Your risk tolerance is the level at which you are comfortable taking a risk and how much volatility and uncertainty you can handle. When it comes to investing, the general rule of thumb is to ensure you don't put all your eggs in one basket. Instead, investors are encouraged to diversify and spread their money across several investments to minimize the investment risk. With that out of the way, let's check out the best places for new and budding investors to begin their journey towards financial freedom. A robo-advisor. For those who have rudimentary knowledge about investing but would prefer a more hands-off approach to making their money work for them, a robo-advisor might be the best option. Robo-advisors are services that help manage your investments with the aid of computing algorithms. Because of the low overhead, robo-advisors don't charge as much as human investment managers would. Usually, robo-advisors charge about 0.25 to 0.50% of your account balance per annum. They are also highly advantageous because they can open an account with no minimum. With robo-advisors, beginners have a safe spot to test the field because it requires very little money and most of the work is done for you. All you have to do is check in periodically and see how things are going. The robo-advisor is the one that does the bulk of the work. Apart from that, robo-advisors can also teach you more about investing too. You'll be able to see how the service creates a portfolio and which investments are currently in use. You'll also get educational content and tools to build your investment skills with some services. A few other services allow you to tweak your portfolio to suit your taste as you grow in investment knowledge. High-yield savings accounts. A high-yield savings account is one of the easiest ways to build your bank account and foray into the world of investing. With high-yield savings accounts, you can significantly boost the returns of the money placed inside them rather than the little to nothing you get by keeping that money in your checking account. With a high-yield savings account, you get more interest than what is offered in a standard savings account, all the while offering ease and access to the funds. This not only works as a great spot to keep funds for an emergency, but it's also perfect for holding money for a large purchase in the future. 401k or employment retirement plan. Most employees have a 401k or another form of retirement plan in place. This should be the first place you put your money when you are considering saving for the future. This type of plan becomes an especially excellent investment plan if your employer matches a part of your contributions. That adds up to free money and a complete assurance of return on your investment. With a 401k, you aren't limited to an investment minimum. This means that you can begin your contributions with as little as 1% of your paycheck. To make the best of what a 401k plan offers, however, it's often advisable to contribute as much as your employer will match. The usual matching arrangement is 50% of the first 6% of the amount you contribute. If you choose to go for a 401k, the money goes directly into the plan without making a pit stop at your bank first. That way, you don't lose what you never really had. Target date mutual funds. A mutual fund is just like a basket of investments. By purchasing a share of the fund, investors are effectively purchasing a share of all the companies in it. A professional manager is often in charge of the funds and determines how the funds are invested, but there is often a general theme to these kinds of funds. For instance, a US equity mutual fund only invests in US stocks, which are also called equities. A target date mutual fund has in its basket a combination of stocks and bonds. Say you aim to retire in the next 30 years, you could select a estimated target date fund with 2050 in the name. The fund might first hold stocks, mostly because the retirement date is far away, and stocks have a tendency to accrue higher returns as time goes by. As the retirement date draws nearer, though, the fund would shift your money away from stocks and into bonds. Does this on the premise that you might be risk-adverse as you near retirement age. Index funds. Index funds are highly similar to mutual funds, except that they move on autopilot. Whereas mutual funds make use of the services of a professional manager, index funds build and maintain the fund's portfolio by tracking a market index. A market index is a collection of investments representing a part of the market. For instance, the S&P 500 is a market index that holds the stocks of about 500 of the biggest companies in the United States. Any S&P 500 index fund will hope to duplicate the performance of the S&P 500 by purchasing the stock in the index. With index funds, you are taking a very passive approach to investing, because all that is required is tracking a market index instead of using professional portfolio management. This results in lower expense ratios than with mutual funds. Expense ratios are fees charged based on the amount you have invested. However, just like mutual funds, when you invest in them, you are purchasing a bite out of the market with one transaction. This makes it a relatively low-risk way to invest. Exchange-traded funds, ETFs. ETFs are similar to index funds in that they also are a passive approach to investing and track a market index. Like index funds, they have lower fees than mutual funds, and you can buy into one that tracks a market index, like the S&P 500. Here is where they differ. Instead of carrying a minimum investment, ETFs are traded throughout the day, where an investor purchases them for a share price. However, just like stock prices, fluctuations can occur. The share price is the minimum investment required for an ETF, and it can range from less than $100 to over $300. ETFs are traded like stocks and treated like them too. Brokers used to charge a token or commission to buy or sell them. However, most brokers have actually dropped the trading costs for ETFs. If you hope to invest often in an ETF, like many investors do, you might want to go for a commission-free ETF to ensure you don't have to pay a commission every time you buy or sell. Which of these beginner investment plans resonates best with you? Please hit the like button to let us know if you enjoyed the video. Also, don't forget to subscribe to Finance Hive and hit the bell icon so that you're notified whenever we post new content. Thanks for watching.